Uh, Assalamu alaikum and good evening. Very warm welcome to all our colleagues who are working in NHS. I am Dr. Nadeem Sajjad Raja, President of Association of Pakistani Physicians of Northern Europe. Dr. Hassan Aziz Mirza, Dr. Azhar Chowdhury, Dr. Babar Shiraz will be co-hosts and they will. Can please everyone mute themselves because I could hear echo. And Noman Hamid will keep an eye on the Facebook for questions. So please post your questions in the chat box or on the Facebook. Association of Pakistani Physicians of Northern Europe is dedicated to the professional and personal growth of its members across the UK and Europe, in line with our mission to empower and support Pakistani origin doctors working in the NHS. Today's webinar, Understanding Your Pension, focuses on an area that is often complex, yet crucial to long-term financial well-being. The session aims to demystify the NHS pension scheme, helping participants understand its structure, benefits, and implications for future planning by bringing together experts who can clarify key concepts and address common questions. APPNE hopes to equip our members with the knowledge and confidence to make informed financial decisions. This initiative is a part of our broader effort to ensure that our community thrives not only in their professional roles, but also in their personal and financial security. So now I hand over to Dr. Hassan Aziz Mirza.
Thank you very much, Dr. Raja, President. I'm very thankful to Mr. Jonathan, Mr. Andrew and Jonathan, our finance gurus, Dr. Azhar, Dr. Raja Babar, Abdul Farooq, Abdul Abid, Alia Bashir, Amir Siddiqui, Azhar Ali, Mr. Singh, Colin Thompson, Dan Lorenzo, David Gibbons, Farhan Mir, Huda Kaleem, and Sherlock, Iftikhar Sohail, John Powell, K.H. Bhatt, Mr. Patel, Dr. Muhammad Yunus Tahir, and Mustafa Shajil, Noman Hamid, Dr. Tayyib Haider, all the way from Wales, and Sara Qureshi, and all other who are all in Wales, are available online on Facebook and YouTube. It's a great opportunity for all of us to learn from Mr. Godfrey's. These are two brothers who are finance gurus. I've been having constant conversation with Jonathan. He's a great man, talks very well, and he's got a wisdom around finance. So probably he's a senior professor of finance kind of guy, who knows how to manage money. And probably I think we'll have uh, great help from him, all of us, hopefully. And like you said, making money is easy, but investing and kind of saving money is more important than that. So I'll hand over to Mr. Jonathan Godfrey. Thank you.
Well, good evening, everybody, and thank you for the introduction. I feel like I know a lot of you, but for those who don't know me, the reason I know a lot of doctors, and in this case specifically APPNE, is I spent 35 years in pharmaceutical sales with GSK and AstraZeneca. At the end of, or nearing the end of my tenure there, I decided that the doctor friends and colleagues that I had made needed my help, because they were all pretty good and very good with medicine, and as a result, not so good with finance. So I decided that we needed to do something about it, and we needed to have the requisite level of expertise and competence from licensed financial advisors to advise the medical profession. So I work with IFA advice, and for those who are non-jargon people, IFA in this context is independent financial advice, which crucially means that advisors have the whole of the market to look at. They're not niched in specific sectors, so they look at the whole market and they source you the best, for example, income protection, etc. And because we wanted to form and have a division specific to the needs of doctors, we have IFA Meducation. If you don't like the name, pardon me, because it was my idea, but I did my best. So we, and at IFA Advice, we choose to, and have been accepted by Nadeem and the ExCo of APPNE, we partner support yourselves, and we're thoroughly happy to do this. And it's a synergistic relationship that was really nicely personified at the most recent Heathrow meeting, which followed the cricket that I attended in the summer. And I have to say, on that note, my head is still burnt from that event, but pleasurable it was. So we, from my family link, my brother Andrew, he is a licensed financial advisor, and he is an expert guru on the NHS pension. And this is a crucial area, as will be depicted in the ensuing chat from Andrew, that we feel it's crucial that we should impart to yourselves so you can help to make the right decisions on this very important subject. So I will invite Andrew, please, to commence his presentation. Thank you.
Thank you very much for the introduction. So just let me share my screen.
Yeah, now you are co-host, Andrew. So now you can share your screen.
Thank you. Thank you very much for the introduction, Nadeem and Jonathan. I'm going to share my screen now, and I promise you that at the end of this approximately 1 hour, you will all be quite possibly not experts in the NHS pension, but a lot more expert than you are now. Okay. So, can everybody see my screen, which should say NHS pension, tax and McLeod?
Yes, so clearly visible.
Yeah, that's good. That's a good start. So, I'm a financial planning consultant. I'm going to impart a lot of information in not a lot of time tonight, but I think it will be a very good starter for you to get a far better understanding of your NHS pension, which, as Nadeem said, is vitally important to you. And in my experience in this sector, I am constantly surprised, stroke dismayed at the lack of understanding that there is of the actual value of the NHS pension. Trust me, it is an incredible thing. It's a thing to be loved and desired. And I would dearly love to have an NHS pension. And the latest stats from a survey done by Royal London actually show that NHS pension is approximately 9 times better than a non-NHS pension. So it is a fabulous asset to have. It might not seem like that now because you can't touch it and spend it for quite a while, quite possibly. But in the background, it is accruing and accruing at a fantastic rate that is unmatched anywhere in the country. Because frankly, nobody else, no other big companies hardly at all do final salary pensions or even like the 2015 pension anymore, because even the huge multinational companies can't afford it. So this type of pension is only available in the public sector because it's backed by the government. And it is so good that this is the dismayed element of my intro. I'm dismayed at the fact that in the last few years, something like 1 in 6 members of the pension scheme have left the pension scheme because they just don't understand how good it is, and they get scare stories concerning the tax elements that are attached to it, and they've left. So that is a monumental mistake that hopefully we're going to correct the misunderstanding of today. And these 3 points, telephone, email, and web, are all available to you in the future to enhance your understanding. And following this presentation, I'm going to make myself available for a free half-an-hour consultation with no obligation. So if anybody has specific queries that they want to ask, we can do it together on a one-to-one Teams meeting or a telephone call or a WhatsApp call. There is no obligation, there is no charge. If you want to take it further and there are more complex issues to discuss and more work to be done, then there will be a charge, obviously. Everybody needs to get paid. But at the initial stage, it's all free and there's no obligation. So without further ado, let's get into the bones. This is the agenda. We've talked about who IFAME Education are. We're going to look at your NHS pension statement, which is your total reward statement, which no doctor seems to understand fully. The flexibilities that have been introduced into the pension scheme in the last couple of years that have made it even more attractive. The annual allowance, which everybody gets worried about, and everybody gets worried about the tax that's attached to it. And lots of people leave the pension scheme to avoid the tax, and that's completely wrong. The McLeod remedy, which is a remedy to put right the illegal age discrimination that was imposed on younger doctors when the 2015 scheme came in. And again, nobody seems to understand that. The NHS was supposed to give you comparative statements to help you understand it. And their deadline was October 2023. And they're just about getting them out now. And then there are also elements whereby if you left the pension scheme at any stage during what they call in the remedy period, which is 7 years from 2015, when the 2015 scheme came in, up until 2022, when the 1995 scheme ended. For 7 years, if you left during that period, you could argue that you only left because the information you were getting was wrong and you'd been discriminated against, and you can retrospectively rejoin the scheme. And that might be a very worthwhile thing to do, as we'll look at later. And finally, we can look at the situation where lots of doctors, because you're so busy and you're so busy doing your vitally important work, lots of doctors just forget about the pension, carry on working, don't claim it for years and years and years after they're liable to be able to claim it. And guess what? You don't get retrospective catch up. They don't say, oh, you should have claimed this at 60 and you're now 63. Those 3 years when you should have been getting paid have been lost. And you'd be surprised at how many of your fellow doctors are in that position. So this is all about how these people can help you. And I just need to give this disclosure as part of regulatory compliance in the finance industry. What we're talking about tonight is educational, it's informational, it's to help you with understanding. It is not financial advice and it is not a sale. So into the bones of it, this is the primary document that helps you within the NHS understand your pension. Unfortunately, it's only a snapshot in time. It is updated each year. It's the total reward statement, and this is the annual benefit statement within it, which covers whichever pension sections you're in. And most of the doctors that I deal with are in both the 1995 and the 2015. It's an annual document that shows you your position at the end of that particular pension year. And pension years run March to March. Therefore, we're coming up to the end of the 25-26 pension year, which will end in March 26. But it takes about 4 months for the NHS to update the records. Therefore, you don't actually get your latest total reward statement until about July/August. So the latest that you will get, if you look for it today, and you can get it online through NHS BSA, TRS online page, the latest that you would get today would say updated to, well, it would be updated to 2025. However, in the 1995 section, because the 1995 section closed in 2022, nobody's service record goes beyond 2022. So your 2025 statement will still say, for the 1995 element, it will still say updated to March 2022. That's for everybody. And it will still be saying that in 26, 27, etc., because 95 ended in 2022. So lots of people get confused by that. So this particular person is very much at the top of the scale, and he's got CEA awards, and he's on 148,000. And that is generally his basic pay plus a CEA award would be what your pension is based on. And as the benefits are equated in standard terms and then maximum lump sum terms. So let's look at the standard benefits, which is the default accrual in your 1995 pension scheme. So with a service of 33.5 years, this person with a pay of 148,000 has accrued an annual pension of 62,000. So that will be paid. That's the estimate of the value at March 24, actually. This particular statement was done. The value of his 33 years service based on this pay figure comes out at an annual amount of £62,000 paid every year for the rest of his life after he has started to claim. And in the 1995 scheme, for every £1 of annual money that you accrue 3 times as much as a tax-free lump sum, which is another incredible benefit. So this particular person has got £62,000 coming in annually and £186,000 coming in as a one-off tax-free lump sum. When he dies, when they die, I'm sorry, I keep on using masculine, but obviously there are male and female doctors, but just for brevity, I'm gonna say he. The spouse, which is usually the adult dependent, will get half of the pension. So 62 will become 31. Now, back to my original statement about how incredibly good the NHS pension is. What this term means, hypothetical annuity cost, it is an estimate of how much it would cost if anybody went into a pension office, Legal and General, Standard Life, tomorrow, and said, I want to buy a pension contract that pays me £62,000 a year and gives me £186,000 tax-free. And they would say, yes, we'll sell you one of those. It will cost you £1,560,000. So I get so many doctors who say, oh, well, £62,000 a year isn't a huge amount, but the actual value of it, if you had to go and buy it, is a huge amount. It would cost you £1,560,000. And another way of looking at that is anybody outside the NHS in a private personal pension scheme would have had to have accumulated or paid in over £1.5 million to get these benefits. And we'll see on the next page an approximation of how much this particular doctor will have paid in to get that. And trust me, it's nothing like £1.5 million. So those are the standard benefits, but everybody that I have dealt with doesn't want the standard benefits because they want to maximize the tax-free lump sum. The way that works is that you can get extra lump sum, and it works out at about the maximum that you can get as a lump sum is about 5.5 times your standard pension. So in this instance, 5.5 times 60,000 would give 330,000 as a lump sum. So 330,000 is about 150,000 more than the standard lump sum. So how is that extra 150,000 all tax-free paid for? It's paid by taking a reduction in your standard pension terms, and your standard pension is reduced by £1 a year for every £12 that your lump sum has been increased. So in this instance, your lump sum has been increased about £150,000. So that's about £12,500 on a 12 for 1, which means that the annual money drops from 62 to about 50. And the other beauty of the pension is, even though you've chosen here probably to get this huge increase in the tax-free amount, and it has decreased your annual money, even when you die, your dependent still gets half of your standard money. So it's not half of your new reduced pension because you're getting a higher lump sum. It's half of your original standard pension. Okay, so just remember this figure, £1.5 million. And we'll go on to the next slide, which is the 2015 scheme. So in 2015, a new scheme came in, and the new scheme is far more generous in some elements and far less generous in others. So its generosity comes in the fact that you don't earn 1/80th of your salary each year as pension, which is what happens in the old 95 scheme. You earn 1/54th. So that is a significant amount more each year that you accrue. However, the quid pro quo of that is that the normal pension age is a lot older than the normal pension age in the 95 scheme. So it's 67 rather than 60. And the other detriment to this scheme in comparison to the old scheme is that it does not accrue an automatic lump sum. So in this instance, the guy joined in 2022, which just means, if you remember on the previous slide, the 95 ended 31st of March 2022, and that's because the 95 scheme closed down and no more services accrued in the 95 scheme. It all goes into the 2015. So the day after, that's when he started in the 2015. And this, on this particular slide, it was done in 2024 and it was updated to 2024 at the time. So in 2 years, he's accumulated nearly 5,000 in annual money, but unfortunately nothing more in lump sum. And if you went to a pension company and asked for these benefits, £5,000 for the rest of your life, they would charge you this amount, £89,000. So that's the value of what he's got in 2 years. Now, again, everybody wants the maximum lump sum rather than no lump sum. And the way that works out is the maximum is round about 4.5, not 5.5.
No point to.
Sorry. Okay. Not 5.5 as it was in the previous slide. So 4.5 times that, he can get £20,000 as a tax-free lump sum rather than zero. But to pay for it, he has to reduce his pension 12 for 1. So his pension drops from 4.8 to 3.1. Death benefits in the 95 scheme are very good as well. So if you die in service, your spouse will get double your pay. And this is an interesting figure, and this is an actual total reward statement. So it's not one that's just been made up. This is actual. He's paying in £20,000, but he's not paying in £20,000 because he's getting a big amount of tax relief on that. So he's paying him more like £10,000. And if you remember from slide 1, he's paid in for 33 years. Well, this is the amount that he's paying in now in his 33rd year. And it won't have been anything like that in the first 10 or 20 years, for instance. So let's say over 33 years, on average, he's probably paid in about 10,000. So he's paid in £250,000 to get a benefit, which back on slide 1 is valued at £1.5 million. So another way of saying that is somebody in a private pension would have had to have paid in £1.5 million and he's paid in £250,000. So again, the pension scheme is fantastic. Please do not leave it. Okay. The pension scheme got even better from October 2023 because prior to that, there was a disadvantage to claiming your 1995 benefits. So 1995, you can retire at 100% of the value of the pension that you've accrued. You can take that at age 60, but you only get 100% full value in the 2015 scheme at age 67. And a lot of people wanted to get their hands on their pension money at age 60. But prior to October 2023, the consequence of that is if you wanted to continue working, but just claim your 95 benefits, you had to leave the pension scheme altogether. So I had several doctors at that time who were in those circumstances, and they'd got very high benefits in the 95 scheme, and they wanted them. They could claim the maximum tax-free allowance, which is 268,000, and they wanted that, and they were prepared, even though they were carrying on working in the pension scheme and they could see the value of the pension scheme, and they wanted to contribute to it ongoing, they weren't allowed to. That all stopped in 2023 because the government decided we need to make it as attractive as possible to retain highly valued, highly experienced, highly skilled medical staff. So they said, now you can claim your 95 benefits, carry on working, carry on paying into the 2015 pension scheme, and accrue even further benefits. So that was a great change for the doctors. And it is very, very flexible. So you don't have to take all of your benefits. You can take minimum 20%, maximum 100%. But I must say, all the doctors that I've dealt with have all taken the 100%. If you're going to do it, you might as well do it to the full. And the only condition with this partial retirement, it doesn't change your job contract in any way, shape or form. There's no renegotiation of seniority or management responsibility or anything like that. It is a seamless transition in every way, apart from you have to get agreement with your line superior for at least a 10% reduction in your pensionable pay. Now, that doesn't mean your income, it's your pensionable pay, that element of your income that goes towards your pension. And it shouldn't mean that you actually have to take a 10% pay cut. Unfortunately, in a lot of instances, probably about 50-50, it does end up that you have to drop 1 PA and drop 1/10 of your income for a 12-month period. But that is simply because your particular trust is inflexible or unable to do what the NHS BSA employment website guides them to do, which is they should be able to, and in my experience, about half the trusts can do it and do it. They should be able to simply separate your 10 PA standard work record out and keep 9 PA pay record linked to a pension contribution record and just remove 1 of the 10 and remove its link to its pension record. So you're still getting paid for 10 PAs, but 1 of those PAs is counted as non-pensionable. And in my experience, about 50% of doctors who've gone for partial retirement have ended up in that position. They didn't want to lose 10% of their income for a year, and their trust was able to do that, delinking for a year, and then reconnect the 10th PA, so it earned pension. But in about 50% of cases, the trust either couldn't be bothered to do the work or didn't have the capacity to do the work, and the doctor actually had to drop 1 PA. But in a lot of instances, a lot of doctors were quite happy to drop 1 PA, frankly. So it's something that you work out with your line superior. And in 100% of cases that I've dealt with, everybody ends up with an agreement. I've only had 1 or 2 where the agreement has taken a few months to be made. Most of them, it's pretty much instant with your line superior. And that's the only condition for doing partial retirement. Okay, so annual allowance. The annual allowance, again, in my experience, seems to be the number one reason why doctors leave the pension scheme. In some instances, I've talked to very senior, very skilled doctors who have adjusted their work rotas to keep themselves under a specific tax threshold, and it's all such a mess, and it really isn't necessary, as I'll show very shortly. But how is the annual allowance actually calculated? Well, the annual allowance that you're given is 60,000. So that's a threshold point at which, if your pension has grown, and I'll explain how grown is decided, it's simply an HMRC calculation, and it's not complex. It's got nothing to do with your pension contributions. Doesn't matter how much you put in. It's how much your pension is deemed to have grown. And this pension input amount is quite simple. So at the start of the new pension year, you take the opening value at the start of that year of your pension. Let's say in that year you've earned £4,000 annual pension. It's multiplied by 16 because that is HMRC's estimate of the minimum amount of time that they're going to have to be paying this out to you. You add the lump sum and you correct it for inflation, because it wouldn't be fair if your pension was deemed to have grown hugely and it was simply because inflation had rocketed, because that wouldn't mean that you were getting an actual true net benefit. Because, okay, it's grown, but it's not all real, because what you have to spend it on has cost a lot more as well. So it's corrected for inflation. That's the opening figure. And then at the end of the year, there's a closing figure, what you've earned in that next year, and you just take one from the other and it equals your pension input amount. And trust me, if it's gone over £60,000 threshold, it means you've done incredibly well in terms of accruing pension. So, okay, it's not nice that because you've done incredibly well, you incur a tax. However, what you have to bear in mind is that the amount of growth up to this threshold has already been, you've already had probably a 40% or even 45% tax benefit in accruing it in the first place, because that's what HMRC adds on for you. Because when they compute your income tax, however much is going into your pension is subtracted from your salary before they charge it to income tax. So you've already had a 45% benefit. If you go over 60,000, it means your pension has grown a heck of a lot. It's done very, very well. It's been helped to the tune of 45% or 40% by HMRC already, and they just want a bit of it back. So it would be nice if there was no tax involved, but there isn't a bottomless pot. But let's see whether you should really be scared of that tax. So there's the answer for you at the start. Don't be scared. And again, this is a real live actual case. And I had somebody say to me, oh, my management responsibility went up and it wasn't pensionable. That is the case in some instances. In a lot of instances, it is pensionable. It's a grey area. But this is just used as an actual live example that I had available that shows the picture very well. So this particular person has had his pay increased by £15,000. On his wage slip, he can see a figure that he is paying £18,000 a year into his pension. And because his pension has grown very significantly, because his salary has increased significantly, he has gone over that 60,000 threshold, and HMRC are going to charge him £31,000. So on the face of it, simplistically, this is quite probably where the legend that I'm sure some of you have heard trotted out, I don't want to pay to go to work. I wouldn't be surprised if this sort of example is where this comes from, because at a simplistic level, this is the good bit, £15,000 more in his salary, but he's already paying £18,000 into his pension. And okay, he's getting his pension, but he's not really focusing on how much his pension has gone up. He's just looking at a tax charge of £31,000. So it seems like he's getting 15,000 extra pay, but it's costing him £31,000 to get it. And what he's completely forgotten is the fact that this is a one-off event, whereas the pension will be paid for as long as he lives, which hopefully is going to be something between 20 and 40 years. So in this particular example, these are the actual figures. Before he got his management responsibility, his pension, his annual money was 35,000, and his lump sum was 3 times that, 107,000. Because he got this management responsibility increase, he got a huge 1-year increase in his annual money. When I say 1-year increase, it's increased hugely in that year, and it will be paid for as long as he survives. And that annual money has gone up £6,000. And if you equate that to the UK state pension, which is about £12,000, that means in 1 year, he's got 50% of what the UK state pension pays, and it takes 35 years to accumulate. So he's got that in 1 year, up 6,000 and up 18,000 on his lump sum. However, he's got a tax bill to pay of £31,000, which doesn't sound very nice. Nobody pays a £31,000 tax bill from their back pocket. What they do is they pay by a system called scheme pays. And all that means is your pension scheme pays. And the way it works is whatever the tax bill is, you settle it with HMRC by saying, you wipe off my tax bill and I will agree that I will take less pension when I take my retirement as a consequence of you wiping out that tax bill. And the way it works is whatever the tax is can be settled for 1/20th, i.e. 5%, as a reduction in your pension. And in this case, the reduction is, instead of his pension going up 6,300, it goes up 1,300 less than that. And his lump sum, instead of going up 18,000, there's 3,000 taken off that. However, so this is where he was. This is where he would have been if there were no tax implications. And this is where he is after he's made that tax completely disappear. It's gone. He's not taken 31,000 out of his back pocket. He's said, yes, knock £1,300 off when you pay me my pension at retirement, and knock nearly £4,000 off my lump sum. But what he's left with is still a huge increase, massively more than practically anybody gets outside of the NHS. And the actual cost benefit is down here. And we can see here his gross contribution before the tax relief that I talked about is 18,850. After that tax relief, what his pension contribution, how much he's paid in to accumulate this huge extra pension, is not 18,000, it's 8,000. That is it. That is his net cost of getting that pension increase. So that's the cost, 8,000. The benefit is 5,000, not one off, not for 1 year, for as long as he lives. So if he lives 20 years, that's £100,000. If he lives 40 years, that's £200,000. And he also gets £15,000 as a lump sum. So for a true cost of £8,000, he gets twice as much as that back tax-free. And he also gets a benefit, which if you went in to that pension company and asked for a benefit of £5,000 every year of life, they would charge you £100,000 for it. So it's cost him £8,000 to get £100,000 benefit there and £15,000 benefit there. So for £8,000, he's earned £115,000 in value. Don't leave the NHS pension. Moving on, NHS pension McLeod remedy. So I'm sure most of you know the basic details, so I'm not going to spend too long on this. But what happened is, in 2015, NHS brought in new rules and wanted to replace the 1995 scheme with the 2015 scheme. And what they said was that older, more senior doctors who were closer to their normal retirement age in the 95 scheme could stay in the 95 scheme, but younger doctors had to join the 2015 scheme. There was no choice. And they were told at the time that that would fall foul of age discrimination rules. And guess what? They blundered on, and stupidly, they made a big mistake, and now they've got to correct it. So at the time, there was a system called transitional protection, which is what I just spoke about. Those closest to retirement age could stay in the 95 scheme. That's been removed retrospectively. The 95 scheme is you'll also see it referred to as the legacy scheme, the old scheme, and the reformed scheme is the 2015 scheme. And you now, as doctors, as pension members, it's your choice. So you can decide for what they call the remedy period, which is 7 years from April 2015, when they first brought the 2015 scheme in, to April 22, when they ended the 95 scheme. You can decide for over those 7 years, do you want those 7 years accumulated within this scheme, or do you want them within this scheme? And the NHS was supposed to be able to give you comparative statements showing what you get if you choose this one to put those 7 years in, and what you get if you choose this one to put those 7 years in. They were supposed to be able to do that for you in October 2023. And I've only just started seeing those statements coming out now. Whereas I can actually do those statements with NHS data and have been doing them since October 2023. Okay. That's the timeline. We've just said all that, really. The beauty is you don't have to worry about it now. You can make your choice when you retire, and I do a pension report which can already do the McLeod comparisons for you if you were thinking of retiring soon. So this is an example page from the report that I do, which is a 20-page report. I don't just do the report and leave you with the report. I do the report and take you through it in entirety. And at the end of it, you are an expert on your own pension, and you can make the best choices and get your best retirement rather than just whatever the NHS says you're entitled to, which unfortunately, they reckon that about 1 in 7, 1 in 8 data items from the NHS have errors in them. And I come across a lot of them a lot of the time. So what we've got here is we're comparing the McLeod choices, and on the left, we've got the 95 choice, and on the right, we've got the 2015 choice. And this particular doctor is like a lot of you. He's got membership in both sections. I've only come across a very few people who've got membership in the 2008. Most people will be in 95 and they'll be in 2015. So the left-hand side here is saying that this person is choosing for that remedy period, 2015 to 2022, to have those 7 years accrued under the 95 rules. And this is what he ends up with, doing it that way. And on this side, you've got those 7 years pushed into the 2015 scheme, and you get a comparison. So let's look. 1995, normal pension age 60. He's going at 60. Therefore, there is no early retirement deduction. He's accrued 58,000 in annual pension and 175,000 in lump sum. There's no deduction for early retirement, and he's got a very small amount of scheme pays deduction. The dark lines are the standard benefits, and the pale lines that I've highlighted are the maximum lump sum benefits, because, as I say, I haven't met a doctor yet who doesn't want the maximum tax-free lump sum. So here he's accrued 58,000, and if he took standard benefits, he'd get 58,000 because there's no deduction because he's not retiring early. However, If he takes 58,000 pension, he only gets 174,000 lump sum. And he doesn't want that. He wants the maximum tax-free amount, which in any instance is 268,275. When we saw that figure on page 1, for any of you that are particularly alert, it was 333,000. And it is a fact that you can, if you've accrued enough, you could have a lump sum in excess of this figure. And I have come across 3 or 4 cases where they could have taken 333,000. However, anything over 268 is instantly taxable, and you end up paying a tax rate of about 60%, and you get nothing like the difference between 268 and 330. So it simply isn't worth doing. But here, he wants to increase his lump sum from 174 to 268, so round about an extra £100,000 tax-free. He pays for that by the 12 for 1. Therefore, he gets about an £8,000 reduction in his annual money, which drops from 58 to 50. And that benefit as annual money after tax represents this in his back pocket after income tax. On this side, here are his 2015 benefits. And because he's doing this choice, putting those 7 years from 2015 to 22 into the 95 scheme and not the 2015 scheme, he's only got a small amount over here. So it's 12 versus 50. And remember, it's an older pension age, 67. And for each year that you retire early, your pension is cut. And we'll go on to that later. That's why I do inverted commas around the cut. It's cut by about 4% for each year. So 7 years gets a reduction of 29%. And you add this side to this side, and it all gets paid as one. And here he's getting 62,000 annual money and 268,000 lump sum. When you do the same on the reform choice, where he's choosing for those 7 years to put it into 2015, you can see that what he gets in the 2015 scheme for the 95, what he gets in the 2015 choice, McLeod choice, as the 95 element has dropped from 50 to 35 because he's pushed 7 years. He's pushed 7 years out of the 95 scheme. So it's dropped from 50 to 35, but he's pushed them into the 2015 scheme, which has increased from 12 to 22. So you add the 2 elements, and that comes to 58. And again, he's already maxed the maximum tax-free amount of 268. So you can see here clearly on my report that he is £4,000 a year better off by doing a McLeod choice, which puts those 7 years in the 95 scheme. And the market value of that 4,000 increase is about £80,000. So he's obviously going to choose as his McLeod choice to do the 95 legacy scheme. Lots of people made contingent decisions during this remedy, what they've now classed as the remedy period, 2015 to 22. Because the government illegally discriminated, in law, any decisions that you made, you can claim. You don't have to have some lawyer represent you, and you don't have to have some detailed explanation or justification. You can just say, oh, I did that with my pension in that period. You broke the law. You need to correct it because I wouldn't have made that decision if you hadn't broken the law. What I'm talking about is there's the 7 years. Some people stopped their added years because they were paying too much tax and they didn't understand the tax. Some people completely gave up added years. Some people did the hokey cokey with the pension scheme, i.e. left the pension scheme, adjusted their work schedules, went back into the pension scheme, all really because they didn't understand the tax elements. But so it was really a mistake to do that by the doctors, but because it was a mistake that they made during this period when the government made their mistake of illegally discriminating, you can actually claim that you would have taken a different course of action if they'd known that continued membership of the 95 scheme was an option. And this is the absolute vital thing here. There will be doctors who left the pension scheme completely. And if you've left the pension scheme for more than 5 years, you lose your final salary link. So that means that if you came to claim your retirement and you'd left, say, in 2016, and you were earning, say, £60,000, your benefits accrued up to that date would be based on £60,000. If you now claim, oh, I only did that because you gave me misleading information, I want to rejoin and get my service re-established from 2016 to 22, another 6 years. The way it works is you don't get it free. You'd have to pay the contributions that you would normally have paid if you hadn't left back in 2016. But those contributions will get you exactly the amount of added pension that you would have got if you hadn't left. And again, you don't pay it out of your back pocket. You can actually pay it through scheme pays. And what it means is when you retire, your 95 pension won't be based on the salary in 2016. It'll be based on your salary now, which could well be 140,000. So it could have a massive increase for people who had left the scheme and can now link their 95 service back to their final best, most recent salary rather than the salary when they left the pension scheme, as long as it was during this 7-year period. This is another dismaying figure, right? And this figure is from a freedom of information request made personally by me in October last year. So in October last year, there were 15,000 doctors who were in excess of 60, and some of them 68, and had not claimed their benefits yet. Now, back to, well, the title is Use It or Lose It. And I've already said that unfortunately, there are, well, you're all busy, you're all doing extremely difficult jobs, and things can get left unattended. Do not unattend claiming your 95 benefits at their full value at age 60, because if you don't claim it, you lose it. And I've personally come across one doctor who is 68 years old, lovely, lovely guy, very, very senior surgeon as it happens. And he just hadn't thought about claiming his pension. And that pension is actually £60,000 a year. So that is 8 years from 60 to 68 that he should have been receiving £60,000. So it's a real shame, because he's, like I'm sure you all are, a very committed person doing his best, and he just forgot to claim. And he's not alone, but it's cost him £500,000. In my experience, most doctors are in a range of receiving an annual amount of between 30,000 as a minimum and about 60,000 as a maximum as a pension. You multiply 30 or 60,000 pounds each year by this figure, and it's a range of between, and I'm rounding slightly, but between £500,000 and £1 billion each year is not claimed by extremely hard-working individuals who've worked all their life to get that benefit, but are too busy doing the day job to think about it. So please don't be one of those people. You'll be pleased to hear, no doubt, because it all is quite complicated. It's not the most exciting subject, but it is a very important subject for you. One of the most common questions that I get asked is it worth me retiring early? Right? And this is quite a good illustration of, in my opinion, if it was me, I would retire early. But my opinion is my opinion. I'm not giving you advice. I'm telling you, I'm informing you what my opinion is. And you have to make your own judgment based on a plethora of considerations. But the main ones being, are you a person who values a bird in the hand or two in the bush? I.e., do you want your money now and to enjoy it productively whilst you're younger and healthier and more aspirational? Or do you want it later when, again, in my opinion, you won't get as much bang for your buck? But let's just go through the calculation. If you retire early, yes, your pension is cut. But I want you to think of this analogy. For each year, the cut is around about 4%. So if you go a year early, it's cut by around about 4%. But don't think of it as you're only going to get 96% of what you should have got, what you've accrued. Yeah. The analogy is you have got a sack of gold and that's your pension and it's up in the attic. Do not think that HMRC send in their goblins, open the sack and dig out 4% for 1 year, 8% for 2 years, 12% for 3 years, etc., building up to 20% for 5 years. Yeah. No, that doesn't happen. What happens is you get the entire sack, every single coin, but it gets spread thinner because it has to be paid longer. Because if you retire at 55, you're going to get it 5 years earlier than you should have. So for those 5 years, you should have received £0. Now, in this particular instance, the gross pension that the doctor has accrued is £30,000. After tax, he's going to end up with £26,000. If he retires at 55, it's cut, inverted commas, by 20%. So 30 is cut to 24, and 26 after tax goes to 21. So 26 to 21 gives an annual net cut of £4,800. So that's the consequence of retiring 5 years early. You're going to get, in this instance, that much of a reduction every year that your pension is paid, every year that you live. However, what's happened is, yes, this is 20% less for as long as you survive, but you're getting it paid for 5 extra years. 5 times this figure is £108,000. So you're getting an extra £108,000, but annually it's being cut by £4,800. It would take 22 and a half years to be better off. By that time, you're nearly 80. So you have to make the decision. When do you think your money is going to be more productive for you? At 55 or when you're nearly 80? So that, you'll be pleased to hear, is the end of the presentation. I'm just repeating this. It was educational. I didn't sell anything. It's information, not selling a financial product. And just another second on the sponsors. So IFA Education can be contacted by 3 means, all of which are on this presentation and on the slide. So they have an email, a phone number, and a website. These are pages on the website, and you can book a free consultation via the website, or you can ring up on this number and ask for it, or you can send an email to the email address on slide 1 and also on the final slide, which I'll put up in a second. And bear with me. Why is it not doing that? Trying to blow that up. Yeah. This is on the website. It's very simple. Name, contact number, email address. What is the nature of your inquiry? Click a button and IFA Education will contact you.
Thank you, Andrew. Thank you very much. I will.
Thank you very much, Andrew. So
You're very
before
welcome.
I hand over mic to Dr. Azhar Chowdhury and Dr. Babar Shiraz, I would like to invite Dr. Tayyib Haider for his comments, please. Dr. Tayyib Haider.
Can you hear me? Can you hear me?
Yes, please.
Yes, thanks, Dr. Raja, and thanks, Mr. Godfrey. I must say this was probably one of the most, not only interesting, but most educational session on NHS pension that I've ever heard. So thank you for organizing, and thank you for a very, very clear presentation.
Thank you.
Thank you. Now, Azhar Chaudhary and Dr. Babar Shiraz, please, for questions.
Thank you, Andrew. It was very educational, and to be honest, learned so many things today. To have to go over again to digest everything. There are a few questions in the chart box. The first one is, what are type 1 annual certificate for GP partners and type 2 self-assessment for the salaried and the fixed term GPs?
Sorry, I missed the.
What are the type 1 annual certificates for the GP partners and the type 2 self-assessment form for salaried and fixed term GPs?
What's the actual question?
So they just want to know what type of the type 1 annual certificate for GP partners. I think we have to fill up each February, I think 28th of February, our kind of certificates, pension, statements.
Yes, and it's different depending whether you're a partner or a salaried employee, and it's type 1 or type 2, but that will all be on your annual record.
Yeah.
And it's simple to should be as simple to get your pensionable pay record via PCSE as a GP as it is to get your TRS as a hospital doctor.
Similar, related to this, another question: do salaried and locum GPs need to fill any form in February for NHS pension which has tax implications?
It depends whether they've received an annual allowance pension saving statement. It's all these questions aren't questions that you can answer in this forum now, because I'd have to see the actual circumstances of that particular doctor, which is the follow-up.
Yeah, I think as a partner we do that, but as a salaried and locum, maybe I think they don't need to. But yeah, they can contact yourself and get more information and advice about it.
Yeah.
Okay, there's another one. Thank you, Andrew, for your presentation. There's one question. Somebody's phrased that if what will happen to their pension scheme if they have contributed for 5 to 7 years and they happen to go overseas to work somewhere else, for example, and leave UK? Will their pension will be secure, or should they opt out, for example?
Their deferred pension will be very secure. The NHS pension scheme is a massive, and it's the biggest pension scheme in the country. It's not going to go under. It's not like when you hear about pension scandals where companies have gone bust and people have lost their pension. If you think about it, hopefully the UK government is never going to go bust, and it's a public sector pension scheme that is backed by the government. So it's completely safe. If you are taking a break from the pension scheme, I would recommend keeping it less than 5 years, because 5 years is the rule whereby links to a final salary get broken. So you need to keep it under 5 years, really.
The other question is, can someone go back to 95 scheme having chosen 2008 one when choice was offered?
Again, it's not an easy one to answer now because there were different rules in going from 2008 and 95 at the time. And we'd have to see what options they were given at that time. It's quite complicated.
Can someone still receive pension under 1995 pension scheme while still continues to work after 60 and not actually retiring?
Well, what would be the point of that? Because I've just put the slide up to show people who defer or either, people who haven't claimed their 95 pension scheme at age 60. For every year that they don't claim, they lose that annual benefit. So in that example that I gave, there was a 68-year-old doctor who could have claimed £60,000 a year for 8 years from 60 to 68, but he didn't. So he lost £500,000. So everybody, in my opinion, should claim their 95 benefits at age 60. So aged and everybody, this is another important point. At the moment, you can claim your benefits from age 55, but there will be an early retirement reduction, the 4%. Yeah, but we've just seen the true cost benefit isn't that significant. What was I going to say? I've lost my point a little bit. You can claim it from 55. Yeah, you can claim it from 55. If I was a doctor, and again, this isn't advice, this is my opinion that I'm giving you, informing you. I would quite probably claim the 95 pension. I would start compiling my figures and getting my forms in before my 55th birthday, such that I could claim it all at age 55 with the consequent 20% reduction, but I'll still be better off until I'm 77. And I certainly, if it wasn't 55, I certainly wouldn't still be leaving it unclaimed by age 60.
Second part of question was, so you can claim at age of 60 under 95 scheme, but they can still continue working till the age of 67.
Yes, yeah. I said that in the presentation. If you remember, prior to 2023, I had doctors who did exactly that or wanted to do exactly that, but they weren't allowed to because they had to leave the pension scheme. The twisted logic at the time was, oh, well, if you're getting a big benefit, a big pension benefit, which non-public sector people, if they claimed their pension, they wouldn't be able to carry on working. That would be it. That's giving too much advantage to the doctors. So we're going to have to make it disadvantageous for them to do that. They removed that because it was daft and it was encouraging people to leave when they really want people to carry on working. So most of the cases that I deal with now are doctors aged between 55 and 60 who are retiring and partially retiring, claiming their 95 benefits, quite often claiming their 2015 benefits as well, but then carrying on seamlessly in the pension scheme, in the 2015 scheme, and accumulating further pension.
Yeah, can I come in here now, please, and just say there are more questions. There are more, let's call them personalised questions. Just to reiterate, anybody, and please take advantage of the opportunity that has been, put forward on the contact numbers to come through to. To repeat, Andrew has kindly said anybody wants to speak to him post the event. There'll be no charge. You can have a chat. You can talk about your personal circumstances. I know that Andrew has another engagement that he needs to be taking part in quite soon, and we are already at past 8:30. So what I would like to thank you is for your time. I'd like to expressly thank Andrew for presenting and portraying a subject that is very convoluted, is very difficult, but is fantastic. And as an absolute minimum, we must stop your colleagues from making monumentally bad decisions. And the way that you do that is by speaking to Andrew and the team. So this is the first of what we are going to provide as a suite of financial webinars. The next one will be inheritance tax, then we'll deal with investments and protection. But if we can call it a day for this evening now, please. Every question that has been asked will be answered post this webinar, but if we can call it a day now, and I thank you, the President, thank you, Nadeem, thank you, the team, and we'll liaise with you soon.
Thank you very much, Andrew and Jonathan, for organizing this webinar. This was really very useful. And after attending this webinar, I'm pretty sure that we all have much clear understanding of how our pension works and why it is such a valuable benefit. Thank you very much, everyone. Now I invite Hassan Mirza for final comments, and then we end this session after this.
Thank you very much, everyone who was attended. I think it was a great talk, and I hope, we still got questions coming in, and I hope Jonathan's address and number is available. Anyone who wants to contact him, he's of great help, and we'll be conducting more financial webinars very soon. Thank you.
I just realized that our executive member, Dr. Abid Iqbal, is also in our audience. Dr. Abid Iqbal, over to you.
Thank you very much for very good presentation and very eye-opening on the NHS pension. I am at the moment on regular touch with HMRC due to my NHS pension issues, and I am in touch with Andrew to try and help and sort it out. So would recommend everybody.
That's kind. Thank you.